Good morning and welcome to your Financial Empower Hour. This is Jason Cryderman with Great Lakes Investment Advisors. It's been a while, Tony, since we've done a live show or a recording like this. I think we took a week or two off because you had some things going on. I had some things going on, but here we are back in the studio. It's great to see you again. It's great to talk to you. And we have an awesome guest with us today. We have Mr.
The biggest.
Keith Gangl. Yeah, Keith Gangl, portfolio manager with Gradient Investments. So I'm excited. I'm excited to be in the studio again recording. I'm excited to catch up with you guys and hear what's been going on in your personal lives. I just came through spring break, and then as we record this, it's Monday, the April 6th. So it's Monday after Easter. So how have you guys been? What'd you guys do for Easter? How was the holiday, and what's going on over in the great state of Minnesota?
I'll let Keith jump in, and by the way, though, before Keith answers that, you got the title a little wrong. There's supposed to be a senior in there, portfolio manager.
Yeah,
let's make sure everyone knows Keith is a senior.
Keith, okay. I
portfolio
manager.
That's due to my age, the no hairline, the gray beard. That's what the senior comes from. All right. Now Easter was great. A little family time on both sides of the house. So spent Saturday with my side of the family, and then Sunday, Easter Day with my wife's side. It was good. I mean, my kids, there's no, I got 3 college age, close to Jason's age, and kids are similar age, a little bit older, 3 in college. So there's no younger little ones running around. All my brothers have, same age kids. So there's no like Easter egg hunt for kids, which I kind of miss. That's always kind of fun to see that.
Yeah,
so
you can still do it for the adults.
It's funny you say that, Tony. My middle-aged daughter, she's 22, I guess, just turned now. And about 3-4 years ago, we stopped doing it for a few years, and she just kind of threw like a little, we got to hide baskets. So guess what they did? Last night we had baskets for them, and that was fun. So one of them couldn't find it right away, so she was all bent out of shape, which I kind of laughed. And then they're like, well, "Dad, Mom, since we couldn't find ours, we're gonna hide something for you." And I said, "Why, we don't have." So what? Again, I don't even like it, but they hid whiskey bottle for me. I'm not a whiskey drinker, but we're down in the basement behind the bar. They said, "Oh, let's hide something for you, Dad." I said, "Well, here's a liquor bottle." So they hid that, and I couldn't find it for 15 minutes either. And they kind of out of that. So that was my entertainment Easter. How's that sound?
That sounds like a great Easter. Sounds like an awesome Easter too. One of my college roommates was telling me kind of the same thing, right? Their kids are getting a little bit older, and hiding all the eggs and those types of things kind of wears out. But he was telling me that his son and daughter decided instead of Easter eggs, they wanted the parents to hide beer cans. So they got a 30 pack of beer, and they had beer cans around the house in the yard, and the kids were all excited because they'd wake up Easter morning, and they're both over 21. They'd wake up Easter morning and run around the house in the yard finding beer cans. And I thought that's Easter Bunny nowadays isn't like what they used to be.
Well, I'm happy to introduce that next year.
Nothing says celebrating the birth of Christ like hiding beer and whiskey.
Yeah, like crack a cold one, right? I mean, God bless America.
Easter was down till we were at the end of the day, so we had all the other family functions, so it was fine.
That's fine. That's good.
What about you, Tony? How was the holiday, and what's been going on over there with you?
Well, in fact, we had a great Easter weekend. We drove down. This is the first time this has happened in a long time because my parents aren't that communicative anymore. They're in their 80s, and they both have Parkinson's, and it's tough. They need full-time nursing care, but my kids and their significant others, we all went, and my wife and I all went down to spend Easter with them.
Oh, how cool.
And we had reserved a little room there in the facility, and we brought a bundt cake from Nothing Bundt Cakes here in the cities, which are delicious. Keith probably knows those bundt cakes, famous. Anyway, we had a great time, and it was so good because it was good to see my mom and dad laugh at the kids' stories and the jokes and the stories we told. And then I just got back from Nashville, where my best friend and best man in my wedding he lives in California. He surprised me by showing up in Nashville for my birthday party.
Fun.
Told me, there's no way I could make that. I'm out in California. It's my wife's birthday weekend. I won't be there, but have a good time. Well, he was there.
That's super cool.
Yeah, that was really neat. So I've really had a great couple of weeks. 2 weeks ago, the birthday party, then Easter Sunday, and just being together with my kids because they're all gone. We're empty nesters. They've all now graduated college and have, one's married, the other is probably soon to be married, the other's in training for the career. And so they're all out of college now, out of the house. But that means when we can all get together, it means a lot. And it really meant a lot because it was with my parents. And, they're not going to be around forever. So that's important. And it's about a 3.5-hour drive down to where my parents
that's
are,
pretty
so.
special. I mean, you think about that, that family time. And, as you mentioned, as parents and grandparents of your children, the older they're getting, they're they just don't have as much time with the family and the kids and the grandkids. And so to be able to spend that family time and I tell my family that all the time. And, a lot of the families and clients that I serve, I tell them there's way more to life than the money. Yes, we're financial advisors. Yes, we help people organize and manage their financial affairs. But at the end of the day, it's those memories with the family, Tony. It's just what you and your wife got to do is spend 3.5 hours in the car with your kids and go see your parents and watch your parents laugh and smile by hearing their grandkids tell stories. And that's what Easter. I mean, think about that, the holidays and Easter, and be able to do that special time with the family. So that's awesome, man. I'm glad you got to spend some really good quality time with the family.
Yeah. Thanks. It sounds like you guys had a lot of family time as well, and that's good. I mean, that's what it's about. Creating experiences and memories means so much more than just the stuff, right?
It really does. And so we kind of going back to what Keith said about, our kids are a little bit younger still. So Lexi's at Michigan State. She's turning 19, and Josie is 15, and Carson is 12. So they still get the baskets. We do baskets in the morning for them. I think this might be the first year we didn't actually hide the baskets behind the curtain or under the those types of things. We didn't do eggs this year. This is the first year the kids were like, we're too old for this. So we didn't do the eggs this year. But Lexi came home from Michigan State, which was great. It's been crazy this year, with her off to college, as you both know, because you both have had the older kids that go off to college. And this was the first year that we realized our family spring break vacations are probably over. Yeah. And what I mean by that is Lexi had her spring break 3 weeks ago from Michigan State. And yet Josie and Carson were still in school. So Lexi got to come home, but we couldn't plan a trip anywhere because the other two, her younger siblings, still had school. And then Lexi this past week was back in school at Michigan State, but Josie and Carson had spring break. So it was really a kind of an eye-opener this year to be like, wow, our family spring breaks, when we're all on spring break together the same week, you get to plan a vacation and go away. We're done. They're over now that our kids are older and in college, and spring breaks don't line up anymore. But we got to spend some really cool, special quality time with Lexi when she came home. That was awesome. And then Carson and I and one of my best friends this past week, we jumped in a car and drove out to Pike County, Illinois, and Pettis County, Missouri, Sedalia, Missouri. So I do some deer hunting down there in the fall, and with my buddy Ricky. And so we jumped in the car, went down and did some scouting and some shed hunting and put out some trail cameras. And so Carson got to tag along with Rick and I. So we had a little men's trip, and we spent 4 or 5 days out there traveling the country roads and checking out the farms, and had a really, really great time. Got home and spent the Easter weekend with the family. And that's always an awesome, special time as well.
Did you find any sheds?
Actually, we did. Yeah, we did. So, talk to any of my hunters out there, if you're my listeners or viewers, and you're thinking shed hunt, right? I mean, people put on literally miles and miles and spend hours and don't find anything. So we were at this farmer's where we stayed down there in Pike County, and he said, hey, just down the road about a half mile, he's got another farm, and there's a big pond on this farm, and Carson loves fishing. So this guy said, well, this pond is stocked with catfish and bass. Go fish all you want, have fun. So we pull up to this pond, and we get out of the truck. 10 feet from the truck, in the clover field around this pond, there's a shed. No. It's a nice little, the left side of an 8-point. And I walk about 30 yards further down to the pond. There's the matching side, the right side. So literally we're out of the truck for 30 seconds to go fishing, and I found a matching set of sheds right there in the clover on the side of the pond. The next 2 days, we walked over 5 miles through woods and up and down hills and cornfields and bean fields and didn't find a speck of a shed. So that's just, I guess that's how it goes. But it was pretty cool. We did get to find a nice little 8-point shed down there. And then at that pond between 2 days, we fished probably an hour or two each morning. Then we'd go do our things around town and out at the farms for hunting and scouting. And then we go back in the evening right before sundown and fish for about an hour. And in those 2 days, I'll bet Carson fished for 4 or 5 hours. And I'm telling you guys, he caught no less than 200 bass.
Wow.
It was crazy. Like my buddy Ricky and I, we probably caught 40 fish.
I think he was over his limit. Jason.
I
don't think that's legal.
Well, it was all catch and release.
I know.
I didn't keep one of them. But it was amazing.
One. Don't you eat them? Don't you eat a bass?
Well, those ones we were just kind of down there for fun. And
Sure.
so then the farmer said, hey, next time you guys come down, you need to thin some of those out. He said, feel free to keep them. But it's, as long as they're the legal limit, keep those fish because we need to thin that pond out because it was just literally 10 casts and you'd catch 8 fish. It was awesome, but it actually got kind of boring. We outfished ourselves but it was a great time. And my boy, Carson, he was in his element, out there, hunting, fishing, loving every day. And it was so cool just to sit back on the tailgate, listen to some music and my buddy Ricky and I, and watching Carson fish in the pond. And so great time had down there. Great Easter weekend. Here we are back to reality. It's Monday morning as we record this show. It's April 6th. Crazy world right now that we're living in. Crazy things geopolitically here on our own soil, overseas. We had a shuttle launch this past weekend. We had the Easter Bunny. I mean, there's a lot going on. So we're going to dive into today's show. We're really going to talk a lot about, basically what's I guess a quarterly update, like what happened in the first quarter of 2026. We're going to hear from Keith Gangl, Senior Portfolio Manager of Gradient Investments, to tell us a little bit about the markets and the economy. Like what happened through January, February, March, and some of it was kind of a fallout maybe from fourth quarter of last year. Was that a good or a bad thing? What's going on now with oil and precious metals and inflation? And let's start cutting through, Keith and Tony, some of this geopolitical noise, this BS. I mean, there's a lot going on, right? And I tell a lot of my clients this, and Keith, you'll be able to really help us understand more of this. But I tell a lot of my families that I serve that a lot of this noise and this stuff is kind of built in. It's already priced into the market, right? Yeah. So the market kind of forecasts some things, and because a lot of people say, "Gee, how come the market didn't react worse?" And I said, "Well." And so you'll kind of, I guess, educate us, and I call dumb it down. Okay, I love it dumbed down for me. I understand very simple things, and so dumb down all this stuff for us today, Keith and Tony, on what the heck's going on, and then we're gonna wrap up with an outlook on 2026, like what's changed with this conflict we're now. If we go one direction, what might happen? And if the conflict goes another direction, what? Because this is all unknown. We don't know right now, but we kind of just got to get a foundation. And I'm sure we're going to say this a lot today. And I say it every single time I have a phone call or an office visit or do one of my educational classes. Now's not the time to panic. Now's not the time to freak out. We're going to be absolutely okay. Crisis creates opportunity. Now's the time actually to revisit that plan that you have, maybe reallocate, maybe rebalance a little, look at discounted value opportunity, be positioned with some dry powder to pounce and take advantage of opportunity. Last thing we want to do is panic. Last thing we want to do is knee-jerk react. And Keith, you're going to help kind of keep us on the straight and narrow today as we talk about where we are in the market and the economy.
Yeah. Well, Keith, Jason, you said Keith's going to talk about, talk about what happened in the first quarter. I think it would be quicker if we just talked about what didn't happen in the first quarter. What didn't happen in the first quarter would be a shorter list and probably fit within the show better. But we will discuss the first quarter. First, I want to give away 10 copies of Jason's book to help people get started on their financial journey or make it through. And it's called Empower Your Retirement. And, plan for the best or hope for the best, but prepare for the worst. Be prepared. There it is. Jason's holding up his book for our viewers. Empower Your Retirement. The next 10 people to contact Great Lakes Investments, contact Jason's team there and ask for the book and mention they heard about it on the show. We'll get a copy. No charge. They'll mail it out. They'll even cover postage. Or you can come in and set up a no-charge consultation and get a copy of the book. That's 989-835-7203. Call 989-835-7203 or go to greatlakesinvestmentadvisors.com to set up a consultation. Let's continue with your Financial Empower Hour. Keith, I think you've got your marching orders. You're the senior portfolio manager there at Gradient Investments. The first quarter has been a little wild with all the geopolitical actions, the markets. People are concerned. Are they going up? Are they going down? Where are we going to end up? It was kind of a negative first quarter, right?
Yeah, there's a lot going on. You guys talked about it all. I've been doing this for over 30 years, and it's certainly been a lot of concerns out there. Every year is concerns. Let's just not forget about that. But this lately has been a lot of volatility, to be expected with what's going on. The markets for the last 3 years have been fantastic. When I'm referring to the markets, I'm referring to the S&P 500. That's the stock market. If you see us on TV or other people talking about the market, they're referring to the S&P 500 more than likely. Last 3 years have been great. Yeah, 26% in 23, 25%, 24, 18-ish% last year. And then this year we started out positive. And I think fundamentals are in place for a good year. And then all of a sudden the Iran conflict war, whatever you want to call it, kind of kicked up. And then after the first quarter, this last month that we had seen, I just wrote a commentary piece called the March slide. We saw the market sell off almost 5% in March. And then after the first quarter, now we're down. The S&P is down about 4.5%. So again, that all basically came in the last month, coincided with, the conflict in Iran. And the reason that investors are getting nervous and why they're selling off is, Jason touched on it earlier, is the price of oil. That is a big deal. And again, I'm still positive on this year, but the one, if I, normally, I focus extremely on corporate earnings growth rate, and we'll talk a little bit about that, I'm sure, here in a second. But the thing now investors are focusing, myself included, is the price of oil. Price of oil is a tax. I mean, obviously in Upper Michigan, here in Minneapolis, people are driving, commuting, but that price of oil is not just transportation. It goes into everything we're talking about. These speakers that you see, these resins, anything that's plastic, the input price of oil goes into it. So coming into this year, that I was saying, hey, I'm very positive on this year. One of the kind of hidden tailwinds no one's talking about is the price of oil at $65, which is very reasonable. I think that's a tailwind for the economy. And now, flip that, just in a month, it's gone from, or 6 weeks, gone from $65 to over $100. It's volatile. We're getting 10% moves a day. And the other thing, investors don't like volatility. We just don't, right? If anything's moving, you're kind of like, let's take a deep breath, see what's going on. But now with oil at above 100, if it stays here, and again, I don't think it will. Again, this is my crystal ball. We'll see. But that's what investors are trying to determine, how long it's going to stay here and how high it will be. I think, again, we'll see over time, once this situation gets resolved one way or another, I think oil prices can get back into that. I don't think they're going back to 65, but if they can get to 75, 80, I think that's a normal, just fine, not a headwind, not a tailwind. But that's what I'm focusing on right now. And your question earlier about, what do investors look at? We're pricing out 6 to 12 months. And there's been a lot of activity going on. Everybody forgot. It kind of reminds me of last year. Everybody remember April 2nd last year? What happened? Little Liberation Day, the tariffs got announced. And I always say it's kind of liberated everybody from their wallets for about a month. The markets went down about 20%. But everybody took a deep breath, right? Jason, were you panicking a month last year in April?
Absolutely not. No, absolutely not. And again, it's that crisis creates opportunity. And based on your overall plan and how you manage your portfolio, again, the tagline from my book, right? Plan for the best, but prepare for the worst. And if that's how you approach managing your money, whether you're in your 20s, your 40s, your 60s, your 80s, if you plan for the best, but prepare for the worst, your portfolio should already be positioned for when the market went down 20% April 2nd of last year. Your portfolio should already been positioned for when the market's down
It's only
4, 5, 6%,
Yep.
so far year to date. And why do I say that? And Keith, you can attest to this, because historically the S&P 500 corrects itself anywhere from 2 to 3, maybe 4 times a year, between 5 and 10% per time. So a 5 to a 10% correction is normal. It's
Very normal.
Absolutely normal, with nothing happening. We're talking no waves, no wind, no ripples, no nothing, and the market just naturally does. So right now we're down 4, 5, 6%, and people are panicking and freak. So put it in perspective again, though, right? Rein it in a little bit. Take our emotion out of it if we can. Yes, there's a conflict. Yes, there's a lot going on. So there's more concern now. But you also said 2023, double-digit growth. 2024, double-digit growth. 2025. Those 3 years, the market was up over or close to 20%, 3 years in a row. That's not normal. That's not healthy either. So I was already kind of preparing a lot of my families for, and we talked about it last year, on bring an umbrella, right? Bring an umbrella. We're going to see volatility. It's okay. It's normal. The S&P 500, the markets correct themselves 2 to 3 times per year at a 5 to a 10% correction each time. As long as we plan for the best, but prepare for the worst, right? Prepare for those things to happen. Have some of your portfolio insulated and protected. Have some of it ready to take advantage of opportunity. You will, what we call, weather the storms, right? Weather, and that's where most people are today. I think if you are properly allocated and properly diversified, and those portfolios, those people aren't panicking. They're not freaking out. They're very comfortable. Yes, they're concerned, right? We don't know what's the end game to this conflict. How bad could it get? But again, having a plan, having that plan be properly allocated, properly diversified. Keith and Tony, I mean, that means the world to your money when we start going through these things. And Keith, you've been doing this for over 30 years. You've seen a lot of the ups and downs, and as well as I've been doing this for about 24 years. And Tony's probably been doing it for, put mine and your years together, Keith.
Yeah, good
That's
point.
how long Tony's been doing this. So, but yeah, no,
thanks.
You're very welcome. So I think that's important to point out, is the market was on a tear 3 years in a row. It's normal to have corrections. We're going to be okay.
Yeah.
We have to be prepared. So to get what I call your in the trenches, right, Keith? I consider you guys as senior portfolio managers. You're in the trenches every single day. You're doing all the research. You're doing all the intelligence. You're doing everything that has to do with it. Where to be, where not to be. How does this impact this? And so to get your knowledge and expertise on what the heck are we going through right now? What does it mean, big picture? And what might happen moving forward, and what should investors consider doing or not doing based on what might happen. So thank you again for your time. I love having you on the show.
Yeah, no, you do a great job. The stats you threw out, I mean, that's usually what you and I are talking about. And those down pat. It's 2 to 3 corrections per year. Yeah. We're in one of them. Do I think it could go worse? It could, and don't get me wrong. Again, a lot of it, unfortunately, depend on the price of oil, which, again, I don't think anybody's going to be able to predict right now. We could see a resolution to what's going on in days, weeks, months. The longer it lasts, the more a headwind it will become for investors, and then it'll make things a little bit more difficult. But you've already planned for that. I mean, you have your clients allocated appropriately. And if it starts to get to that situation like last year, that April 2nd, for that month, it was almost down 20%. That's the time period when I start getting a pit in my stomach. I know that's when I start recommending that people that have that kind of money on the sides, that kind of protection, safety, you actually want to lean into the market. Now, are we there yet? I don't think so. I think, this is just a normal correction. They're not fun. I don't like looking at my statements. You don't like your statements. Clients don't like looking at them. But take a step back and say, oh, look at what we've done for the last several years.
Yeah.
Corrections are normal, but where's our end goal? Am I meeting my income objective? And your clients, yeah, they're mostly likely, that hasn't changed. Now their principal maybe has dropped here a little bit, but I still think fundamental, once, are in place. And, if I had to pick one thing, X all this noise over the last 30 years to look at, is corporate earnings. Corporate earnings are expected to grow 16% this year. Just to put that in perspective for you guys. A normal year is 5 to 7. Last year we did 11. This year we're supposed to accelerate to go to 16. Now, I think 16 is a little bit high, especially with the price of oil, and that's a tax on consumers. That could certainly be 10 to 12 to 13 still. And that's a healthy backdrop for the stock market. So again, it's a very fluid situation, but every day we're analyzing where can we upgrade our portfolio and things like that.
Yeah. I think, and I want to dig into that just a little bit, the company performance versus, what a world leader, what Iran did or Trump did yesterday affecting the markets. And this first quarter, we've experienced a lot of that, but you have to look at the fundamentals. Before we go on, though, speaking of fundamentals, and Keith, you led into this great, you and Jason, you need a plan in place when the market is volatile. When the market does go down, you don't have to worry because you've got a plan in place. Jason and his team there at Great Lakes will have a plan for you where if you're in retirement and the market goes down, you have money you can pull to cover your bills from other areas. You're well diversified. It makes sense. So if you want a consultation and get that plan in place or get a second opinion, Jason, you're offering our listeners and viewers a no-charge consultation. There's no obligation. Just mention you heard about it on the radio show. To set up that appointment, just call 989-835-7203 or go to GreatLakesInvestmentAdvisors.com and you can set up the appointment that way. The phone number, once again, is 989-835-7203. or the web address, GreatLakesInvestmentAdvisors.com. And this is your Financial Empower Hour. I'm your co-host, Tony Shore. I'm here with our host, Jason Cryderman, the man with the plan. And today's very special guest, once again, great to have him back, Keith Gangl, the Senior Portfolio Manager over at Gradient Investments. And Keith, you left off, and Jason, you probably have more questions for him as well. But I want to clarify, you guys, because Jason, you're always telling me this as well. Where I think people get distracted and get upset is that, in fact, this week, it's coming to a head with negotiations. We could see something big happen, negatively or positively. Even today, as we record the show, are they going to come to an agreement? Will the Strait of Hormuz open up? And so far, it seems like the market has kind of been reacting, but it's been holding steady. There's somewhat of a correction, but I just wonder, I want to get back to fundamentals, and the stock market is based on the performance of these companies, right? Not based on, but oil prices affect these companies. So it really does tie in, I guess.
Yeah, it certainly does. If you look at, we always like to use history as a guide, right? Just kind of how does this normally rank? If we look at the last 15 kind of conflicts out there, there's a good chart I saw the other day is, generally speaking, when a conflict happens, that first month markets are down. It's kind of what we see in this corrective territory. It's not even technically in a correction. But then if you look at the following 1 year numbers, that the rebound off that pullback is actually better than the overall market performance. The rebound, like the market average, again, depends on the market. The S&P 500 for the last couple of decades been around that 9-10%. But this study showed these 15 kind of different conflicts, again, was whether it was the all these different wars we're in, the Ukraine, Russia, 9/11, all these different things. The following year, the markets were up on average 12%, which is actually better than the overall market. So that's why we like to put some numbers around things and kind of, does that necessarily mean this is going to play out the same way? Absolutely not. But we like to use history as a guide to kind of say, we've been here before. We've seen this movie. There, history kind of rhymes. It's not always the same. Now, the price of oil, again, that's no doubt about it. That's what the investors are focused on. So if we see some major disruption to the Middle East, just to put some stats on it, the Strait of Hormuz, 20% of the global oil flows through there. A lot less important for the U.S., but certainly other parts of the world, and oil can move around, right? It's movable. So it's certainly will impact our markets as well. So if something would happen really bad, that's 20% of the global supply kind of getting disrupted. And that's kind of what the market's a little bit pricing in this pullback. Everybody's kind of saying, I think we'll be fine. But if something happens where all of a sudden some refiners get blown up and things like that, and you can't get crops and fertilizer, then it goes into foods and things like that. And that's kind of, you paint yourself into a really dire situation. I don't think we're anywhere near there, but that's something we have to pay attention to the headlines. And fortunately, what Jason's done with his clients is he's had them diversified going into. We never know what's going to happen, right, Jason? Every year you've been doing 24, I've been 30. Tony sounds like he's been doing quite a bit longer. There's every year we've been doing this. There's been concerns in the market. There always is. There's never one year I come in and it's like, huh, Jason, easy year. Market's going to be up 12%, 1% per year. Let's go to the golf course, or maybe you and I should go fishing or hunting or something like that.
Well, that's it. I mean, we can find some
happen.
extra things to do, but you're absolutely right. I mean, think about the markets and the economies during the best of times and worst of times. The market just doesn't go straight up. Not every day in the economy is 100% healthy and strong. And, you're going to have ebbs and flows and ups and downs. And again, it's a matter of how are you positioned with your current portfolio, whether you're in your 20s or your 40s or your 70s. It's what is your risk tolerance? What is your income need? What is the outlook of the funds? What are all your goals and objectives? And you should be allocated and diversified. And those two words are really, really key when we're seeing the current economic times we are, is allocation and diversification. And again, the tagline of my book is plan for the best, prepare for the worst. We plan for every day to be beautiful and sunny, right? But you live in Minneapolis, Minnesota. We live in mid-Michigan. We know and understand not every day is beautiful and sunny. So plan for the best, but bring an umbrella, right? Prepare for the worst. And so I love, again, being able to pick your brain, Keith, and listen to kind of from in the trenches. And I know all my listeners and viewers, they love to hear it. Like, gee, what is somebody that's actually managing, billions of dollars? What do they what do they think and what's going on? So let's touch a little bit. We talked a little bit about the oil. Let's talk on like some inflation, interest rates, maybe precious metals, gold. That was on just an absolute tear for a while there. What's that look like now? What's the outlook and forecast? The dollar and strength of the dollar. A lot of things going on. Yeah,
there's a lot of moving parts. And again, this year's probably a little bit unusual that there's probably a little more moving parts than normal, but again, there's always something moving somewhere. And right now you've touched on oil is the kind of the key factor. Everybody's looking at it. Even if you're not an investment person, you're concerned about it. Media's got it in the headlines. You see it at the gas pumps right here in Minnesota. I'm sure in Michigan, you're up probably $1 per gallon. It's like that matters to people, right? That takes out your discretionary bucket and kind of, you have less to spend on your fun stuff, less, money to go fishing trips or whatever the case may be. So that's certainly a talking point that we talked on. Now, what that leads to is that bad, naughty word of inflation, right? Because inflation, that's another tax on the economy. And if you guys remember back, we quoted the stats for the last 3 years in the S&P of being 26, 25, and 18. We go back to 2022, it seems like quite a while ago. But Tony, you remember what 2022 was all about?
It was down. Both bonds and stocks were way down. It was
and inflation was crazy.
That was what I was looking for. Yep, Tony, you guys nailed it. It was basically the reason that stocks and bonds were down because inflation was crazy. Remember all the headlines? Egg prices can't get this, and then you had shortages of here, and so we had supply 10%,
12%.
So then what does the Fed do? The Fed comes in and raises rate, right, to tame inflation, but that generally cools the economy. So that's kind of what they did, got everything a little bit more under control, right? And then it's back to business, focus on company fundamentals, which last 4 years have been solid. So inflation, if oil stays high, that's going to contribute to this inflation upward pressure. Now, do I think right now we're currently a little bit below 3? We're at about 2.7, 2.8, depends on which numbers you're looking at. The Fed's target, the Federal Reserve's target is 2%. We've been saying for a while, we've talked on this before, Jason, is I don't think we're going to get to 2% by year end, but we were close enough, that 2.5, 2. Yeah, it's close. Yeah. If you remember in 2022, we were at 9.2%. So that's a big number. And that's just painful for investors, painful for, your living expense is everyday things. So now oil, again, that's an input to everything. So if oil stays high, that's going to put upward pressure on that, 2.8, 2.9% inflation. Do I think we're going to 4 or 5? No, but we could maybe end up back into 3, which is, it kind of takes away a little bit of the positive momentum from the markets. And then also that ties into interest rates, what you touched on as well. So what does the Fed do? So if you go back to last year, the Fed was in the easing cycle, which means they were cutting rates, right? Which is a two-edged sword, especially for your retirees that you're working with. Generally, higher rates is not the worst thing in the world, right? As long as you don't get that rapid increase, right? Because then it allows them to make more money at safer levels, like
That's
in
right. Yep.
bonds and CDs and things like that. If you guys have been there for a while, you remember, Jason, for a while the banks would pay you zero, and they still don't pay you a whole lot for your savings account.
Well, there was a time in there that putting your money in the bank was the safest way to lose money.
For sure.
Right. It almost cost you money.
It almost did.
Between if you had any annual fees, any statements, and then if you got a 0.001% growth, you paid taxes and you actually went back. It was just, so that's not a good situation to be in either.
No. But I do think so. That being said, so we've gone from the Fed cutting last year 3 times. That means the Fed, they cut, when I say cutting, that it's a 25 basis point cut. Expectation going into this year without all this activity going on was for another 2 to 3 cuts. I'm in the camp. I don't necessarily, I like to, if I were the Fed, I'd keep those as dry powder. That kind of, when the economy starts to slow, you can start cutting and they kind of stimulate the economy. Again, I'm fairly positive on the overall economy, where the stock market's going. So I was under the guise of, well, we don't necessarily need any cuts. And now the market's kind of coming around to that, just due to the fact that we potentially have inflation increasing. Now, I don't think the Fed's going to raise rates either, because that slows the economy. And then if unemployment starts going up, and there's this balancing act between interest rates, unemployment. That's why all these things we talk about, it's crazy how intermingled they are. You push on one side of things, helping one problem, all of a sudden you may cause an issue somewhere else. So that's right. That's part of our job, is to say, okay, where does the Fed need to be pushing? Do they need to be cutting or not? Where are company earnings going? Where's the price of oil going? Is unemployment still going to stay in this range of 4.5%? Which again, it's not 3.5, a 50-year low where we were a couple of years ago, but 4.5 is still very good. If I always like to tell people, if people are working, they have money in their pockets, and no one can spend like the U.S. consumer. They just love to spend flat out. We all have kids, and we have all been through the cycle, and everybody, us as well, we like to spend.
Yeah, our entire economy is based on it. On consumer, it's consumer driven. So I think that is really important, and I'm glad you're making note of it. Now we should take another quick break here and talk about the book. I want to give away more copies of Jason's book, Empower Your Retirement. It's such a great book, Jason, and it can really help people. It's great. It's available on Amazon, but you can buy it, get it for no cost right now. All you have to do is be one of the next 10 people to contact Great Lakes Investment Advisors, and that number is 989-835-7203. Just make sure you say you heard about it on the show. That's Empower Your Retirement, a book by Jason Cryderman. You wrote it with your father, Jason. I think that's fantastic. Get your own copy. It'll really help. There's no cost. There's no obligation, no charge, and they'll even cover postage. Call 989-835-7203. And you're listening to your Financial Empower Hour. I am your co-host, Tony Shore. I'm here with Jason Cryderman and Keith Gangl, our very special guest today. And we've been talking about what's been going on in the first quarter and what we can expect. Jason, we only have a few more minutes left in the show. But what do you want to touch on before we go today?
Well, I always love having, Keith or another member of his team, the portfolio managers from Grady Investments, on the show. I think it's just awesome to be able to pick their brain and learn from what we call in the trenches, right? Deep in the trenches. They're the ones that are doing all the research into, if this, how does it impact this? What about this? How much this? These corporate earnings and inflation and war in the Middle East and oil, all this stuff that at the end of the day, bottom line is, it comes down to how it impacts our money in our 401ks, in our Roth IRAs, interest rates in CDs. So how do these people, this experience and knowledge in their brain, how do they take all this stuff and then put it together and then physically manage billions of dollars of assets for clients all across the country? And so I love having Keith on the show, as well as any other member of his team, whenever I can find time to get him off of any of the other major networks to spend a few minutes with us. So thank you again for that, Keith. As we wrap up the show today, I think we probably got, Tony, let us know, 3 minutes, 5 minutes. But what I'd like to do is put you on the hot seat. I do this quite often whenever I have guests on the show, is say, okay, you got 3 minutes. Give me your top 3 things to look out for. I'm gonna give you a couple categories. Okay, you can give us 3 things to look out for, things to do, or things not to do. Any combination of those, give us 3 to 5 things here in the last few minutes, things to look out for, things to do, or things to not to do. And you're on the hot seat.
All right. Well, we'll start things to look out for. Corporate earnings. So we just got done. I talked about the full year of done at 16% kind of forecast. That's kind of the Wall Street gurus that we read and listen to. 16%, very healthy number. That's the number to watch. If I had to pick one thing for this year to watch besides oil prices, this is headlines, right? That's excluding that would be the thing to watch. I think we're in a very healthy spot, but we definitely have to keep an eye on that. We just got done with Q4 earnings. So it was first quarter. You're always like a little bit of a lag, right? We'll get into Q1 earnings here shortly. That was fantastic. Just so you know that the forecast, the gurus were forecasting 6% growth. They did 11. So that was way better. And that's part of why the market started up this year. And now here in the middle of April and end of April, we're going to start getting into Q1 earnings. So we'll start hearing from companies themselves. How are the price of oil impacting their business models, right? That's something we want to hear. We hear a lot of headlines. The media is going to run one way or the other. You start seeing it yourself in your pocketbook. But companies can adjust. They do adjust. And that's what we're investing in, those companies. We want to make sure we're investing in those companies that can adjust the most or maybe least impacted by these high oil prices, because I think they're here for a little while. I do think we get back into that, that $75, $80, and then we have to stop worrying about that, right? And there'll be some other concern when that props up. So that's a big thing to do. The other thing I can't emphasize enough, and you've talked about it here, is working with you, Jason. You're fantastic. You keep a client well grounded. You not only do you have a diversified plan for them and kind of putting in these different, pockets of money for their different income needs and safety and growth. You do a great job like that, but you also can be a psychologist. That's sometimes what we have to be with not yourself, but new advisors. We have to coach them through these times are normal. I don't like it. You don't like it. I look at my statements. I look at the portfolios all day long. Do I like seeing red, which means markets are down or stocks are down? Absolutely not. I prefer it every day to come in and see green, and everybody can kind of pat us on the back, say, great job, guys. But it's like when markets are down, that creates opportunity as well. And then as a coach, you say, these are normal. I mean, are the fundamentals still in place? Keith talked about earnings. So far, seems like they are. Now, when we start getting the Q1 report cards the next few weeks, I'll be keenly watching that to make sure that's on track. Now, if they start deviating, then we as portfolio managers start dialing back. We'll message to you saying, okay, if you're thinking of having this more aggressive allocation to this client, maybe it's moderated to growth, not full growth model, right? So we'll dial the risk back, and that's exactly what you do. But do you want to play the all in, all out? Absolutely not. That's why if you look at studies that show over time, individual investors earn about 3%, 4%, 5% versus one that's with an advisor earning, market returns plus, because they stay to a plan. The worst case is when you panic on the bottom versus then all of a sudden have to chase the market on the tops. You do a good job of avoiding that with your clients.
Well, thank you for that. I greatly appreciate the hot seat. You did a great job there. And something you pointed out was, I think it's very interesting. A lot of people don't realize this. The average investor historically averages about 3 to 5% annual returns. And a lot of you are shaking your head right now thinking, yep, that's me, doggone it. Why? Because I sell at the wrong time and I buy at the wrong time. And I don't buy low and sell high. I do it the other way around. I buy high, sell low. And so, but if you have a written plan, even if you do it yourself, or have a written plan and stay committed to your plan. Don't change. Don't deviate. Yes, it's okay to adjust here and there, but be careful. Stay committed. Find a trusted fiduciary advisor, myself, another member of my team, or somebody else you trust, and have them build a plan for you. Take some of that emotion out, helps keep you accountable, helps keep you on track. And generally, we're going to have a team like the team at Grady Investments that are in the trenches. They're the ones doing all that internal management. But again, plan for the best, prepare for the worst.
All right, guys. Great show today. Listeners and viewers, thanks for tuning in. Now, before we go, make sure you set up that consultation or get your copy of Jason's book. All you have to do is call 989-835-7203. That's 989-835-7203. And that does it for today's episode of your Financial Empower Hour.